I just wanted to let you know that one of the resources for economics will not play for you guys. So I'm literally going to play it for you now. It's 5 minutes, and then I'm going to post it on Google Classroom. And then I will also link it right underneath the link that's not working. So that way you can easily watch and find it. So here we go.
Respiratory illness known as COVID-19, caused by a novel coronavirus, was first detected in the central Chinese city of Wuhan. Within the first 5 weeks of the outbreak, tens of thousands of people were infected and more than 1,000 died. The outbreak has been categorized as a public health emergency by the World Health Organization. Not surprisingly, the virus is having economic impacts throughout the world. Major companies like Apple, Starbucks, and McDonald's closed stores in China, and airlines around the world have canceled flights to and from the region. On January 31st, 2020, the Dow dropped more than 2% during the day on coronavirus fears, wiping out all the gains for the month of January. However, the U.S. stock market seemed to quickly recover, hitting new all-time highs on February 12th, even as the virus continued to spread. It's not clear how much the virus will impact U.S. investors, but the effects could go deeper than just retail and travel, hitting sectors and industries you might not expect, like energy, automotive, and banking. Mm-hmm. Taking a look at these potential impacts can help you prepare your portfolio for possible market turbulence. As the world's biggest importer of oil, China is a major player in the energy sector. The Lunar New Year typically leads to an increase in demand of jet fuel and gasoline. Instead, demand for oil in China dropped 20% in the weeks immediately after the outbreak, and the price of crude oil dropped about 16% between the outbreak and early February. This is putting some strain on American oil companies. China doesn't buy much oil from American exporters, roughly 2% of exports, but oil prices are set on a global level, so lower prices means lower profits. Companies like ExxonMobil and Chevron saw share prices drop in the first 6 weeks of 2020. At least one firm has downgraded its outlook on oil from bullish to neutral, and it says a further downgrade may be in the future. While a number of factors impact oil prices, like supply, demand, and global politics, lower demand driven by the coronavirus could increase pressure on the energy sector. The coronavirus is also slowing down many automakers. Dozens of car makers across the world work with Chinese suppliers to produce parts for their vehicles, but many of those shops have closed as part of mandatory quarantines. This could result in some plant closures. For example, Fiat Chrysler has warned that some European plants may close if the interruption to its supply chain continues. In addition to supply chain disruptions, automakers may also face decreased demand. One analyst told the Financial Times that China faces a traumatic next few months, suggesting people might even delay buying cars. The high level of exposure to Chinese suppliers and consumers could add risk to automotive securities. While there may be several factors at play, many major manufacturers have seen steep declines in share prices since the outbreak became widely reported.
So I'm going to pause it right here because I want to talk a little bit about what he's explaining. So a couple of things. First off, gas prices. If you notice that here in Colorado, gas prices have gone down. The reason why gas prices have gone down is because nobody's driving really right now. Obviously, some jobs like delivery, UPS, the post office, things like that. If some of your family members are still driving to work and stuff like that. But overall, if you look at teachers are all staying home. We're teaching from home. I don't really even drive my car. I know I'm saving lots of money in gas because I don't drive to school every single day. Or, for example, your school buses take quite a bit of gas, or they run on propane. And with that, they obviously there's a higher demand. So when there's a higher demand for things, then the price of something will go up. But the fact that not so many people are buying gas, that's why we're seeing a decrease in gas prices. So that's one thing that he was pointing out. Another thing he's pointing out is obviously right now with many people losing their jobs, they may not be able to buy things that are a little more of a luxury. Like deep down, I have a car, but I'm not going to go out right now and start looking for a new car. So the automotive industry is getting hit pretty hard as well, due to that factor of nobody's going to go out and really buy brand new cars right now. So, and then obviously the workers are staying at home and being in quarantine. So when that happens, that means zero work production is happening. And when zero work production happens, there's no new cars to be made to even sell. So that's kind of what he's talking about here.
Banking is another industry that's facing uncertainty with the coronavirus. In recent decades, the US and Chinese economies have become increasingly intertwined, so US companies often turn to banks to fund their expansion into China. Growth in China has been stalling in recent years, down from a high of around 14% in 2007. Some analysts predict coronavirus could slow growth even more to around 3.7%. If growth slows further, US banks could feel the strain. According to Moody's, lower economic growth could lead to lower demand for loans and mergers and acquisitions, meaning potentially weaker earnings for banks. With all the uncertainty, consider having a plan to hedge your portfolio against risk. For example, some investors might use exchange-traded funds, options, or futures contracts as part of their hedging strategy. You can also look at what sectors you're invested in and make sure your holdings are diversified enough to withstand any turbulence. Either way, consider your ideal risk and return parameters and set a clear exit strategy in case you're wrong. Most importantly, keep your eyes on the longer-term trends. As of mid-February 2020, stocks were still near all-time highs, corporate earnings were still growing, and the Federal Reserve made it clear it would support markets with accommodative monetary policy. Ultimately, we don't know how the economy will react to this in the long term, but we do know that more than 400 companies have talked about the coronavirus in their first quarterly earnings calls of 2020. Mm-hmm. Being aware of the potential sector and industry impacts of the coronavirus can help you prepare your portfolio. As always, dig past the headlines and look at sources like earnings, analyst reports, and Fed statements to help connect the dots of how major global events can impact markets. Thanks for watching. TD Ameritrade is where smart investors get smarter. To stay up to date on new videos, please subscribe. And don't forget to hit the bell to get notified about new uploads. Be sure.
Okay. So then he started talking about banking. So banking is kind of interesting right now because what the bank normally does is give out loans. A lot of people are a little worried that the banks are going to start giving out a little bit more what are called riskier loans. And with riskier loans, that just means that they're not fully certain that the people that they're giving the loan to can 100% pay that loan back. That definitely hurts our economy. And banks have asked for some bailout money. And what that kind of means is they're asking to get money to make sure that their company stays afloat. There's good and bad things to that. So if we want to talk about that later, we can. And then the last thing that he was saying is the stock market. I just want to be clear that the stock market is just like one portion, like one little thing of the whole entire economy. So just because the stock market is doing rather well, it doesn't necessarily mean that like all Americans are doing well or all businesses are doing well. That's just one little part of it. But the stock market right now is kind of going crazy in the sense of going up and down dramatically. And that's not necessarily healthy. So I guess what he's kind of saying in this video is it's very hard to predict from day to day or even like month to month or even a year from now what our economy would really look like due to coronavirus, because coronavirus is impacting businesses. But it may be okay when coronavirus eventually goes away and the economy could bounce back dramatically in a positive way, and we wouldn't necessarily end up going into a recession. So I hope this was helpful. If you have any questions, please email me or come to my office hours.